mean, that's my goal, is just to help provide some type of education that you get to take away today to help impact more people's lives, and by default, impact your own. It depends. It depends on what you have, right? So for me, what we do, because we look at a lot of credit every day, we will look at somebody that's at a 705. Well, they got a great credit. They qualify. But what if we can get them to a 720? Because what if we get them to a 720 and it decreases their interest rate by 1/8 of a point, or it lowers the amount of cost that it takes to buy the rate that they want down? So let's look at it. We do what's called a what if analysis, and it'll tell us if you do this, this, and this, the score will go there. Sometimes they have business credit cards where the business pays their credit card off every month, but they just haven't paid it off yet. And so we tell the business to go pay it off, and all of a sudden the score increases 40 points, and bam, they're in the top tier pricing, and they lower their rate 1/4 or 3/8 of a point. That's why understanding credit is so important, and also it's understanding the strategy or the game that you have to play with credit. Credit's awesome if you know how to use it. It sucks that we have to tell people to go get in debt to buy a house, but we need to know that you have the ability to repay, and that's the one way that we figure that out. So play the game the right way. Figure out, one, when does your credit card companies report to the credit bureau? Every credit card company is different. Don't assume it's the last day of the month. They're not. Call the credit card company, ask them when they report to the credit agencies. Then, based on that data, pay whatever you need to pay 4 or 5 days in advance of that, so that way when they report, you're in a good place according to their reporting to the credit agencies. So what happens is most of the time they don't do that, and they pay on the day or day after, say, oh, it's due on the 30th, so they pay on the 29th, and it doesn't make the reporting to the credit agencies. Then they come apply for a loan, and we look at it, and their balance is at $10,000, and their credit limit's at $10,000, and they're considered high risk. When the reality is they just paid $5,000 on that credit card, and now they would be at a 50% carry ratio, which is a big number, right? A lot better than 100%, and their credit score would have changed. So we educate people on that. We can do that at 704. We can do that at 580 to get them up to a 620 to qualify for a program. But they're going to be those individuals that honestly just have a habit to break. Yes, sir.
Is there a credit score where if you got that, you're good? Don't sweat the small stuff.
Well, it depends on the loan, okay? Because there are several different things that go into making up a loan. I call them my 4 C's of underwriting. There's collateral, credit, cash, and capacity. Collateral's the house. Obviously, we need to wait till you get a contract to make sure the house is worth what you're buying it for. Credit is one part of that, and it's basically a big part, but it is only one part to the 4 C's. Cash, do they have the money to buy? And capacity, just because you have an 800 credit score, but you have a 75 debt-to-income ratio, you can't buy the home. Those programs used to exist back before the housing crisis. We were doing no income, no asset, no documentation loans for people that had great credit, but we couldn't verify anything else, right? Then we started to lower the credit criteria. Oh, you know what, 720 is that number, don't worry about it, we'll do 680. Wall Street got involved, everything's working, CDOs are awesome, then we go down to 620 because we can all make more money, get more people into homes. Lowering the credit quality, not getting as any documentation, allowed people to make decisions that weren't responsible in the lending side or in the home purchasing side, and that's ultimately what led us to the point where we got, right? So it's only one aspect of the whole approval process, the credit side. Yes, sir. No, you're fine.
Just one follow-on to that. Wouldn't a high DTI drag your credit score down? DTI, a high debt to income.
Oh, your debt to income ratio? So yes, I guess it could if you ask it the right way, because your debt to income ratio is taking in the debts that are showing up on the credit report compared to the income. If the debts are at a high amount compared to the high credit limit, and that's what's causing the monthly payments to be really high, then that's going to have a negative impact on the score. But if you just have a bunch of debt, it's not really like, the monthly balance is not really that high compared to the overall credit limit, but it's just you have a ton of it. That's not really going to negatively impact your credit score because they're looking at how much your utilization rate, how much you've used of that credit. Okay? Yes, sir. Great questions. Thank you very much. And this is what, ask them away. I mean, we'll just keep rolling.